Hello all, welcome to my presentation, Gear and Ungearing Betas, ACCA F9, presented by Sean Bourne. Gear and Ungearing Betas. When an investment has differing business and finance risks from the existing business, gear betas may be used to obtain an appropriate required return. Gear betas are calculated by 1. Ungearing industry betas, 2. Converting ungeared betas back into a gear beta that reflects the company's own gearing ratio. Gear betas are used to incorporate the level of risk due to the ratio of debt to equity in the capital structure of a company. Debt financing will cause the level of risk to rise, financial risk, and hence the cost of equity KE will rise. Equity beta, a measure of risk incorporating both systematic and unsystematic risk. Asset beta, a measure solely of systematic risk. The asset beta will be the same for all companies in the same industry. 1. Convert the beta value of other companies in the industry to ungeared beta using the formula BA equals BE open bracket VE close bracket divide VE plus VD less tax. 2. Having obtained an ungeared beta value BA, convert it back to a geared beta BE, which reflects the company's own gearing ratio using the formula BE equals BA open bracket VE plus VD less tax close bracket divide VE. 3. Having estimated a project-specific gear beta, use the capital asset pricing model CAPM to estimate a project-specific cost of equity. BA is the asset or ungeared beta. BE is the equity or gear beta. VD is the market value of the debt capital in the geared company. VE is the market value of the equity capital in the geared company. T is the rate of corporation tax. Example, gearing and ungearing betas. A company debt to equity ratio by market value is 2 to 5. The corporate debt is risk-free. Yield 11% before tax. The beta value of the company equity is currently 1 to 1. The average returns on the stock market equity are 16%. The company is now proposing to invest in a project which would involve diversification into a new industry, and the following information is available about this industry. A. Average beta coefficient of equity capital equals 1.59. B. Average debt to equity ratio in the industry equals 1 to 2 by market value. The rate of corporation tax is 30%. What would be a suitable cost of capital to apply to the project? Solution. Step 1. The beta value for the industry is 1 1.59. Step 2. Convert the gear beta value for the industry to an on-gear beta for the industry using the on-gear beta formula. BA equals 1.59, open bracket, value of equity in the industry is 2, divide value of equity is 2 plus value of debt 1 less stocks equals 1.18. Convert this on-gear industry beta back into a gear beta which reflects the company's own gearing level 2:1. So we're going to use the gear beta formula. So BE equals 1.18. Value of equity in the company is 5 plus value of debt in the company 2 less stocks divide value of equity in the company is 5 equals 1.51. Step 3. This is the project specific beta for the firm equity capital, and so using the capital asset pricing model CAPM, we can estimate the project specific cost of equity as KE equals risk-free rate 11% plus open brackets market return 16% minus risk-free rate 11% close bracket multiply the beta, which is 1.51, equals 18.55%. The project will presumably be financed in a gearing ratio of 2:5 debt to equity, and so the project specific cost of capital ought to be, for equity, 5 out of 7 multiply 18.55% plus debt 2 out of 7 multiply 70%, which is tax, multiply 11%, which is debt, equals 15.45%. So the project specific cost of capital is therefore 15.45%.